think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. And today you are joining me in Tampa, Florida. So today I came out here because I do film work, I also do photography work, and I was working with a few friends and stuff, and so it happened to work out. It's actually pretty fun, and we were able to get some work done. The sad part about this trip is that my good friend Eli from Urban Lifestyle, he lives about 4 hours away.
And he didn't want to drive the 4 hours to come see me.
So today what we're gonna talk about is the pressure that has been on gold, and I'm gonna explain how does this work with bond yields and what is the fear, what is happening. So as we've been seeing is that the 10-year Treasury yield has been continuously increasing. The 30-year has been increasing as well. It is pretty much related to the interest that is gonna have to be paid back on the debt. So when governments sell bonds and when governments sell treasuries, they have to pay back those treasuries and those bonds with interest. And so whenever you have a negative interest rate or you have a really low interest rate, it's pretty much negative real yields. So real yields is adjusted for inflation. So say like you buy a bond, the government's gonna pay you, 4% on that bond, and say like inflation is actually 6%. So let's say for the next decade, inflation continues to run high, and let's say inflation is about 5%, 6%. Then whenever you hold those bonds, the government keeps your money. So the government keeps your money, you loan it to the government, and they're promising to pay you in the long term. They're promising to pay you in 10 years a 4% interest rate. However, with inflation being 6%, you're losing money over the course of those 10 years. So that's pretty much how that works. So when interest rates are rising, people are thinking about inflation right now. They're thinking about how inflation is picking up. And they're also thinking about how when bond yields rise, it puts pressure on gold. When interest rates go up, it puts pressure on gold. So back in the 70s, we had a lot of inflation, and this inflation ran really high. And then how they fought the inflation is by increasing the interest rates. So when they increased the interest rates, then it was able to tame the inflation. However, we haven't seen a whole lot of inflation yet, according to the CPI, the Consumer Price Index. But that is a metric that is controlled by the Federal Reserve, and they have different things like electronics and things like that in that basket to where it doesn't really show the true cost like we're seeing, every day. We're seeing cost of living rise, we're seeing healthcare rise, we're seeing education costs rise, we're seeing grocery prices rise. I mean, the shipping containers and for importing and export have went up dramatically. We've seen the price of soybeans rise, the price of coffee rise, the price of beef double in the last 2 years. So things like that, we're seeing inflation, but it's not being calculated by the federal government. So now the issue is that this has put a lot of pressure on growth stocks, all these overvalued stocks, stocks that are more focused on growth. Bond yields tend to put a lot of pressure on that. So when yields increase, those stocks do really poorly. So we've seen that the Teslas, we've seen all these different stocks tank this past week, and they pretty much went down and they continue to go down. And this also puts a lot of value stocks in favor. So people run to value stocks, stocks that aren't overvalued, stocks that are actually pretty consistent, pay good dividends and things like that, commodities. People run to those types of stocks. Now, in relation to gold, people are thinking that higher bond yields is going to put pressure on gold, and normally it does. But the factor that people are missing is that our government cannot pay high interest rates on the amount of debt that they have borrowed in the last year. So actually the last 2 years, the government has borrowed a lot of money. I mean, I believe last year we went over $5 trillion. And imagine the government having to pay long-term interest rates, higher interest rates, the bond yield increasing, the treasury yield increasing, and paying that on those trillions of dollars. That's gonna be a lot of money that the government's gonna have to pay out. And it's gonna pretty much render our government insolvent because they cannot pay that much debt back. They cannot pay that much debt back on interest. So after this next stimulus package passes, then we're gonna be close to 30 trillion in debt. So imagine 30 trillion in debt and you're paying 5% on that. You know, that's going to be a lot of money that the government's going to have to dish out in order to service the debt. And if the treasury yields continue to increase, the government is going to be insolvent and they're not going to be able to pay that debt back. So now, do you think that the Federal Reserve and the government are going to allow that to happen? I personally don't think that that's going to happen. I believe that they are going to suppress the long-term interest rates, which means they're going to have to buy a lot of the long-term debt. The Federal Reserve is going to have to buy a lot of the treasuries and a lot of that debt to keep those rates from rising, because the government will be insolvent and the government will not be able to service that debt. Now, once the Federal Reserve does that, because right now short-term interest rates are suppressed, right? The long-term interest rates are the ones that are increasing. And once the Federal Reserve starts to suppress the long-term interest rates, that means that we're going to produce negative real yields. So people that are going to be holding bonds, they aren't going to get paid as much by loaning money to the government. And what's going to happen in that situation means that they're going to lose a lot more money due to inflation. Now, once inflation continuously rises and then you have the long-term debt continuously being suppressed, the interest rates being suppressed, that is going to be absolutely bullish for gold and precious metals. So now with gold being at this price, silver being at this price, being at lower prices, I believe that this is a great opportunity for us to buy and to buy more. We've seen Bitcoin get hit hard. We've seen other stocks get hit hard. So it's a great buying opportunity for people to really see like, hey, this is really cheap. And right now, gold stocks are really cheap. Gold mining stocks are really cheap. And so I've been buying a lot of those myself. So I just want to encourage you guys, be fearful when others are greedy. Be greedy when others are fearful. So that was a famous quote by Warren Buffett. And we see this scenario playing out right now. Many people are fearful, so they're selling off their stocks and they're driving the cost of those stocks down, the price of those stocks down. And these are some highly valued companies. These are some companies that are really valuable, especially in the gold sector. So what I'm doing is I'm being greedy while others are fearful, and I'm buying in at these low prices. I'm buying in gold, silver, and mining stocks. I'm also buying other stocks, commodity stocks such as oil, uranium, and some others. So I just want to thank you all for joining the Money Level Show today. I hope this was encouraging and insightful for you all. Please be sure to hit the like button and the subscribe down below. I appreciate you all tuning in, and be sure to share this video as well with people that you may know. And I want to thank you all for your support. All right, peace.